Morning, good people. Welcome to the Flow Show. Here we are. Quiet day. Nothing happening today. We can all go back to bed. Morning, Kate. You still in bed?
Happy FOMC morning. No, I'm not in bed. I don't have my PC in bed, mate. But I am with you. We might as well turn everything off and come back on Friday.
Yeah, everyone disappear, and then I'll stay here on the sly and see if I can make some money. But yeah, the waiting game once again ahead of these big events. Obviously, the Fed tonight and other bits and pieces. So we'll see what markets want to do in the meantime. Probably not a lot, but we shall keep an eye on it. Right, let's get stuck into what has happened before we start talking about what might happen. Kicking off with data out of China overnight. There we go. PMI morning for China. This is the National Bureau of Statistics number, so the official Chinese numbers here. Manufacturing staying unchanged at, meeting expectations 49.2, up 2 pips from the prior 49, still in contraction. Services improving by 3 pips to 50.7, so that's still going in the right way. They want to see that manufacturing number getting back into positive territory, though, most definitely. Some numbers out of Japan, not overly hot. Industrial production up 1.8%, missing expectations, but still a gain. We also got some retail sales numbers as well. Well, you can see that firstly, that industrial production forecast month ahead, minus 6.2. Before I go into retail sales, a Japanese government official said that the production forecast is seen declining due to the partial auto plant suspension. There's been lots of stuff going on as well with Toyota fiddling their output numbers for engines and whatnot. They've been in big trouble lately, and there's been a few plant shutdowns over there. Right, retail sales 2.1% in December, missing expectations year on year number there. Large retailers coming in on the month lower, down 2.9%. So retail sales not looking a bit mixed, but not looking overly hot over there for numbers for December. We got the BOJ summary of opinions. This is it's almost like a minutes from the January meeting. No real comments of major note in there. A few members saying that they will need to see the economic impact or fallout from the earthquake. So that's still a big feature, part of policy. But otherwise, it's the same old, creeping closer towards inflation target and possible exiting from easy policy. Anything in those opinions you caught, Kay, that we need to know about?
Well, just perhaps I think there was it one member or so said that they should take advantage of the situation before the rest is moving, that it's now or never. But yeah, it's sort of what we expected and what has been transpired and what the radar is always bringing over, right?
Yeah.
I'm no. There's nothing really new. The yen went down 30 points on the fact that all those confirmations that they are going to move, right?
Yeah.
But that's about it. We've seen this morning it's already undone. Well, that's probably month end, which is going on right now. But no, on the data. Last month we talked about those industrial productions numbers, that they can be volatile over there. It all depends on what the big companies are getting as orders from abroad as well. But yeah, the rest, the retail sales over there is blind darts at best. Well, let's say that in good times, because New Year for them is like our Saint Valentine, rather, Christmas and New Year period. So we should have expected a decent move higher as the 4.7 or 5% expected was showing. But yeah, okay, underwhelming. But yeah, I'm not going to read too much in those data. You know, I mean,
Yeah,
Japanese data, for them to move the market, there must be a slew of data going same side and months in a row, right?
yeah, exactly. But those yeah, the monthly number's not looking too good, minus 2.9% from some of the large retailers.
Yeah.
Right. Also on the Bank of Japan, Nikkei piece out, saying that they're highlighting the fact that bond purchases from the BOJ fell to the lowest in almost 2 years. They say it sets the stage for normalisation with a third stealth taper. It's more probably the realisation in the market that the end of negative rates is coming, so yields are likely to go up. We've already heard previously some of the big Japanese whales and pension firms and the like saying they're going to hold off purchasing bonds as well. There's no real stress in the Japanese bond markets, so there's no need for the BOJ to buy more. It's not necessarily they're slowing purchases just because they're going to end their easy policy. So it's a bit of a cause and effect there, but the Nikkei trying to make something potentially out of nothing on that one. To further highlight the lack of action over there, there was zero currency intervention between December 28th and Jan 29th. Not that we were expecting any, but the Ministry of Finance, no need to push the buttons there. PM Kishida has said he will ensure disposable income rises faster than prices, the continued push from the government side of things to get wages higher and get the economy moving once again for his virtuous growth cycle. Over in Australia, and CPI data coming in on the soft side. Over their Q4 data out, quarter on quarter, 0.6, lower than expected, lower than last quarter, year on year, lower and lower too. The December number, because they have got a December number now, they have got a monthly reading, whereas they previously just left it to the quarterly numbers. Came in at, let's have a look, 3.4%. Where was it? There we go. 3.4% versus 3.7% expected and 4.3% previously. So inflation moving in the right direction. A bit like the BOC, they have 20 different goes at guessing inflation, and pretty much all the measures came down year on year. Trimmed mean, weighted mean, your mean, I'm mean, all the means came down in those numbers there. So inflation moving in the right direction for the RBA. Certainly a little bit of a different picture to what we're seeing over at the RBNZ. So keep an eye on Aussie Kiwi for potential divergences in rates over there, and at least chatter from those banks. Over to the ECB, Kazakhs said rates will most likely be cut this year, but we need more information on the labour market before a rate cut. ECB's Wojcik says we need more data before rate cut decision. April or June for a cut is not a big difference. It's not a given that cuts would happen at every meeting. Pauses are possible, which I think is a fairly valid point. Many in the market think that when they start cutting, it's going to be a cut every meeting, but they may go a softly, slowly approach. ECB's McClure says we must remain open-minded on the interest rate path. ECB's Nagel, Germany's Nagel, bit of an understatement here, says the German economic outlook isn't great. Inflation is absolutely moving in the right direction, and the ECB needs more data, and wage data is critically important. That's quite a big headline because we got some Italian data out. It's not on this calendar. Some wage data, which showed a fairly decent uptick in Italian wages. So some quite hot numbers coming in from those guys. So not numbers that you would expect the ECB to start cutting on. So wages not going the right way for Italy at the moment, as far as ECB is concerned. Lagarde was out yesterday as well, and creating a bit of a stir because she stepped into the political realm by saying Europe should brace for harsh decisions if Trump is re-elected. That was speaking to CNN. Many have been questioning why she's making comments about American politics when she's a central banker. And now watch the the interview itself, and you could take some valid points. She was saying, you know, if Trump comes in, these are his policies. These policies could affect us. So that's why we need to keep an eye on it. So that's a fair point. But still, it may be a bit of the way the headlines or the press have spun it. But it all sounds like she's getting a bit involved there above her pay grade, above her job status, shall we say. She was out later on saying we will get to 2% inflation in a timely manner. And everyone on the governing council agrees the next move is a cut. What were your impressions of those comments, Kay?
Yeah, I mean, she already said so in Davos, right? It's kind of a repeat of what she already said during one of the interviews in Davos, and then I was very surprised that she even raised that point, because that is something that a central bank governor should give zero comments about. But I guess that's her other side, more personal side that was a bit too strong. But repeating it in another interview is a bit much. I find. We are not doing in politics. We are not expressing personal views or so, but we can talk about stuff. But she shouldn't. That is really my opinion. She should not really be talking about that. That's something for the politicians to decide, unless she has aspirations for her after ECB presidency. That is possible as well. I wouldn't rule it out. And on the other side, the shift from the ECB members, now that inflation is coming down, now that growth is at zero, is all of a sudden going on to those wages. They took a leaf out of the Bank of Japan's playbook. It's, I'm not going to say a strange one, because I mean, after all, we are looking at them for the Bank of England too. It's a bit logic, but it is a possibility that they are going to use this to push back against expected rate cuts, because we saw also the German, even if the German data came down on the inflation front, the retail sales again showing a negative number over there. But if you look at the unemployment data, they are okay. If you look at the Italian came down a little bit. Italy unemployment, I think, is the lowest in quite some time. I think this we're talking about levels in not seen for 10 years or so, and I think German employment number is also not sure whether it's no, it's not a record low. We've been lower than that, but they're also doing relatively okay. So now they may start to use this as an excuse to fight back against market expectations for earlier rate cuts, right?
Yeah. There's been more than a few ECB bonds pointing to the labour market and wages. Lane is one of those as well. Lagarde, I think, mentioned it last week too. So yeah, we're getting to know what the measures are that they're looking at.
And the shift.
Yeah,
and so we can measures that they are looking at, because I can't recall last year during the fight, the height of the fight against inflation. Also, I can't remember. I can't recall them talking about wages at all.
I do, but only from the point that they were saying they don't see any wage price spirals.
Oh yeah, they don't see the spiral, right?
And then you see those numbers from Italy, and you think, well, if that's not a spiral, I'm a cuckoo. So yeah, Italy is one country, as we just seen. Italy employment doing well, so no surprise to see wages rising. it's still going on. We've heard, we've spoken about the strikes in Germany, airlines and the like. We've got farmers pretty much blockading the whole of Paris in France at the moment. That's not so much wages, but that's still over subsidies and financials that are going on over there. So there's still tons of strikes and that sort of industrial action going on. A lot of it to do with wages, and that's going to feed through, like we've continued to see in the UK with wages running at high 6%. So it is a valid point, but they jump on these points as and when it suits their narrative. And maybe they're just waking up to the fact that there are going to be some wage price spirals. But a ton of data out from Europe as well. Germany import price index there showing more deflationary numbers coming in, down 8.5, worse than expected, though not as bad as last month. On the month, though, it was worse than last month and expected. So Germany remaining well under the cosh. Retail sales looking pretty bad as well. Much worse than expectations for December, down 1.6%. Were expected to rise 0.7% year on year, coming in another negative as per last year. Even Switzerland, cuckoo clocks not selling well, apparently, and chocolate in Switzerland down 0.8%. Were expected to rise 0.9%. These are year on year numbers, though. CPI in France, a little bit different to what we saw in Spain yesterday. Numbers coming down. Still, we've got three handles, still well above ECB target, but moving in the right direction. HICP number not falling as much as expected, but still a hefty drop from 4.1% on that. PPI as well, just looking a bit more soggier, still rise on the month, year on year, down a bit worse. Spain retail sales, again, these are year-on-year numbers, 3.1%, so positive for the year there. There's the unemployment Kay was talking about. Unemployment rate staying at 5.8%. Numbers not too much of a change amongst those. Italy unemployment coming down there. We've had all the German regional CPI numbers as well, which are going to feed into the main number in a couple of hours' time. They're all lower as well. Baden-Württemberg 3.2 from 3.4. Bavaria, that was about the only one that went up, 2.9 from 2.8, but Brandenburg down, Hesse down, North Rhine down. Although it's got unchanged, but I don't think it was unchanged. I'll have to check that one anyway. But generally, Saxony also coming down as well. So we saw a little bit of a spike in those numbers, but they all seem to be coming down. But we're still largely well above target, and that's the theme for all the inflation so far. I've lost my place now. Where am I? Over there. There we go. Lost me bit. Right, over to the US and some of the data that we got out yesterday. Not an awful lot. House price numbers coming in. Nothing really untoward in those numbers there. Prices in the FHFA number still coming in around about 0.3, 0.2% year on year, up a little bit. So maintaining price gains there. The S&P or the Case-Shiller numbers as well. Coming in, the 20 city number year on year came in a bit hotter, 5.4%, but not as much as expected. Prices up 0.1% on the month. US consumer confidence came in much better, 114.8, much better than expected. The expectations number blew the doors off. The current conditions number blew the doors off, coming in at 161.3 versus 148.5 previously. Expectations were a little bit softer though, 83.8 versus 85.6 previously. The all-important inflation number, 1 year inflation expectations fell to 5.2% from 5.6%. So that's the right way for the ECB. And then a bit of a surprise in the JOLTS numbers. Had been on a little bit of a downtrend. Well, it bucked that with a fairly decent jump to 9.026. So that keeps the jobs market on the hot side of things at the moment. Job openings coming down can be an indication that firms don't have the positions available or not looking to hire, but it seems it did. Again, maybe some seasonality in there because it's December numbers, holiday hiring, that sort of thing. So we need to see what the January numbers are going to bring us in the early part of the year. Right, there's a bit of risk chatter that's been going on. Obviously, the attack on the US base had President Biden out yesterday saying he has decided how to respond to the attacks on US troops in Jordan. Didn't give too much away in what he decided, but he then countered that to say we don't need a wider war in the Middle East. And his comments were pretty much along those lines, that they're looking at stuff, who's been arming these people, but he doesn't seem to want to make it a significant step up, should we say, in retaliation. Iran, meanwhile, has vowed to retaliate against any attack, unsurprisingly, there. Those clowns at the IMF have been tinkering with their global economic forecast. They now see a global growth up at 3.1% in 2024 versus 2.9% in their prior forecast. They kept the 2025 outlook unchanged at 3.2%. I did a little exercise, or I like to do a little exercise with the IMF, seeing what they get up to with their forecasts, because they're completely crap at it. You remember, these are the guys who apparently set off all that stuff in the UK, the Liz Truss stuff. The Liz Truss stuff that happened September, was it 2022 now, wasn't it? I think we kicked that off. Well, these are how they get on with their forecasts. These were their forecasts January 2023. These are their forecasts yesterday. And as you can see, for 2023, they haven't hit a single one. They're either coming too low or have under-guessed what economies will do, much like the UK. They expected last year the economy to fall 0.6%. Instead, it's likely to come up 0.5%. Kicking in a bit of an open door, because we already knew that the United States produced 2023 growth of 2.5% in their preliminary GDP estimates. So, you know, they don't look like a wizard on that. But take these IMF forecasts with a pinch of salt. The market likes to look at them. They like to come out and give chapter and verse about what they should do, like the BOJ should normalise policy ASAP. But we should also remember that Lagarde used to be sitting in the hot seat over there. So take that as you will. Lastly, job cuts. PayPal this time. They're apparently going to begin company-wide layoffs. Some 2,500 people potentially getting put out of work. More and more job cut headlines we're seeing, and now the wider market is starting to pick it up. Seen loads of comments. There was also one from Zero Hedge, our old mates, who managed to list all the cuts over the last few months. They even missed a few. But people are now picking up that we're getting all these Q4 earnings that are looking okay, but the forward guidance is looking a bit shaky. Again, I'll repeat, these numbers that we're seeing so far aren't critical. We're in soft landing mode. It's a natural reaction for firms to tighten the belts, shed a few jobs. You know, it's not emergency job cutting because business is falling off a cliff. It's just part and parcel of things may not be as rosy this year as they were last year. It's only if we start to see big job cuts coming that we need to be worried about it. But trend is your friend, and the trend is looking a bit more negative right now. And those job cut numbers are adding up. So we have to keep an eye on that one. Okay, anything from you, mate?
Nothing that you haven't mentioned yet, Ryan. I think that's good enough for one day.
Cool. Right, so what have we got? We've got the Fed coming up, obviously. Just get a quick look, see what data we've got coming up later. Got the NBA stuff, keep an eye on that. And obviously ADP coming in, that'll be bang in the middle of face. So we'll be covering that one live. Also got some Canadian GDP as well. And then I think that's it. So nothing else until the Fed later on. Kay, I'll get your thoughts first on the Fed. What do you reckon for tonight?
Okay. My base case is that it's going to be a very soft meeting. That is, no decisions made. The January, is it the last meeting, or is there any other smaller ones still to come out? January, apart from Hungary and Turkey, will have been a month where we have repeatedly said central bank keeps rate unchanged. So that's the base case. There are a few things that can be market mover. That is one. Is Powell going on, and his FOMC mates, are they going to start to talk about those job cuts in a way? But then it's never been supported by, if you look at the Jones, if you look at the, yeah, I think we had 1 weaker also ADP number out, and then by the NFP, apart from revising mostly the prior month number a bit lower, they haven't really shown any weakness. So that's going to depend. That is something where he could be grilled on during the press conference, and whether they will acknowledge it or not. That would be if they do a bit of a dovish land. And then the other one is the RRP, the reserve repo situation. It's coming down. There's a bit of pressure has been taken off by the US Treasury announcing a smaller than expected refunding program. We, by the way, should have at the end of phase today the repartition of what they want to do. That is, last time in November they were prioritizing the bills over the bonds, and let's see how the repartition will be today. Because let's face it, $750 or $760 billion is still a hefty amount. That is going to be a point before the FOMC, but then on the FOMC, are they going to start to take this RRP level coming down into account? In which case they could talk a bit, because as I recalled, Powell was a bit uneasy and evasive on the question when he was asked about the question in December. We are now a month and a half further, so there has been a bit of further evolution on those levels. So is he going to talk about it? Are they going to start to put some kind of a plan in place to talk about reducing the QT a bit? So those are the possibilities which could give this meeting a bit of a dovish slant if they really talk about it. If in turn they brush everything under the table right now and send us straight to March without talking about much at all, I guess that's going to be taken as a bit hawkish by the markets. Knowing Powell, he can navigate in between both. So as we've seen over the past press conferences, he likes to start talking one side and then slowly changing onto the other side. So my base case is a very soft meeting, not in the sense bully, hawkish or dovish, but very, very soft meeting this month. That's my base case.
Yeah, no, I think I'm in full agreement with that. I'm sure he has a bet with all his other Fed governors about ranges. I'm sure he has a little ticker screen on his podium, and he says, right, I'm going to move yields one way with these comments, and I'm going to move yields the other way with these comments. And they all have little bets on the ranges, I reckon, because yeah, I think he's going to do exactly that. Walk the middle line, speak on the risks, how the economy is doing, how they're not ready to cut yet, but ready to do so, that sort of thing. So I think it's going to be a balanced thing. Trading wise, it's a case of watching the levels. We've come, even if you look back at euro dollar, we've come through ECB meetings, Fed meetings, all the meetings, data, everything, and we're still stuck in this range. So I don't see any reason why that's going to change anyway at all, unless there's something game changing. So the bigger price risk is something game changing, because if that comes, no one will be expecting it. But otherwise, this might be a bit of a bore fest to go through, but I'll still keep an eye on the levels. You know, something maybe up towards 109s. I'm still long my longs from down here, but I don't mind having a little short play up here if we get a bit of a rally. Likewise, I don't mind a little bit of a add back or a short-term long trade if we get down to the 107s and we test some of these big levels. But that's going to be my main theme for later, just highlighting my levels on the charts and seeing if I get any that I'm happy to trade. Same can be said for dollar yen. 147 we know is a bit of a level. We've got these highs up here to lean on, higher up in the 148s, up towards near 149s. So that's the sort of area I don't expect any range breaks to happen at the moment. Just going over some of the others. I'm getting, yeah, go on, mate.
If I may, on this yen, I find it a very dangerous currency to trade right now. Just we see those moves lower, and there's always some half a headline saying that, oh yeah, it might be the case, and the market loves to buy yen these days. And then every time it kicks back in the face, and we come back to the middle of the latest range between give and take 146.5, 140, 149 on the wide. It's a bit of a dangerous currency to trade right now, and I'm rather happy, barring some really fast scalps, not to have like too much of an idea right now, or too much of a strong opinion on the yen right now, because again today we have seen that euro yen, for instance, coming under a bit of pressure. Then you have those lower CPIs coming out. Then you have that weaker German retail sales coming out, and you could just see that people were leaning on that euro yen, and then all of a sudden, bang, you're trading 50 points higher again. And I find it, and I've been trading and market making yen for a very long time, but I'm finding it within the broader range. I'm finding it a bit dangerous right now to have any opinion at all. Really, I probably will have an opinion sooner rather than later, because I can't keep away from trading. I'm a trader, but and I'll show it on a couple of charts, but it's very dangerous right now to have short-term opinions, because nearly every move has been countered by a move, by a counter move. Same thing to the top side. If you look at last week or so, we were like dollar yen was going from 147 to 148.5 pretty rapidly, sucking probably in a few guys saying like, or ladies saying like, all right, this is it, we've seen the bottom, now we're going long. What happens next? Bang, you come back to 147. And I find it very, very dangerous. I just wanted to highlight that, because to me at least, it's a dangerous currency to trade right now.
Yeah, I mean, the same could be said for a lot of currencies. You know, we get moves over data or headlines or whatever, and then it just reverts back to the mean, if you like, to the average or the middle of the range. Yeah, I'm still, my bias is probably still bearish dollar yen, but not touching it at the moment. We've got still got a couple of months to sort out what's going on with the wages and stuff like that, and obviously the carry to consider. But over the FOMC, we're bang in the middle. If we get a move to either side and it holds, then that's where I'm going to be sniping from the edges. And it's the same thing. The only one that's still looking weaker is euro dollar. But even that, it's just when you think it's going, it bounces. Just when you think it's going, it bounces. But it is keeping this downtrend going. It is still looking a bit soggy at the moment. But again, where's my levels? Have a look at 107. Maybe down towards this fib area, 107. That I might look at picking some up, as I say. Top side, 109s. Anything above 109, probably look a bit juicy for anyone who's been selling in here. But this one is probably one that it is coming back to its medium, but only in a day-to-day basis. We've still got this downtrend forming, so it is creeping lower. Aussie dollar, same thing. We're just bang doing nothing, going sideways. And I mentioned in the room today that I'm getting a bit cautious. I'm still long some of this, but I'm getting a bit cautious that we're not managing to break and hold above 66. We had a little peak Monday, above 66.20s, couldn't hold it, down we come again. And what I think is happening in here is we're getting a lot of people trading the short-term levels, you know, a lot of scalpers and whatnot getting in, jobbing it around. And there could be a bit of complacency about this range, which means when it does shift out, it might have some legs and we might get a bit of a stronger move than we would do normally. But again, this one over the Fed down here, up there, I might be doing something, but not anything here in the middle for this one. Going to have a look at the S&P just as an update. Still long this one. We are coming down and testing the break point, the prior break point that we had when we got through 49s. We couldn't get through sort of 49.05. We made the break, we tested the break, we've held the break, and we're just edging down through it. I would not be surprised to see this coming back down ahead of the Fed. There's going to be a lot of short-termers long around these areas here. The earnings have still been pretty okay, but it's been the forward guidance and these jobs headlines that seem to be tipping things over. I mean, half of this big move came as Google missed on its Google ad revenue by 280 million on 65 billion, and the market got spooked and came down 5% after market yesterday. So getting a little bit of a shock in stocks, but we're creeping lower. I wouldn't be surprised to see some further profit taking ahead of the Fed, ahead of the risk event. So maybe we'll have a look through this 49 area, maybe even down as low as 48.60. Again, I'll see how this happens over the Fed. If the Fed are a bit hawkish and we're going to move down here to this break point, but we can't get through, I may think of adding back into my longs because we're not seeing the trend break just yet if we bounce from there. But yeah, bit of an open door, bit of a coin toss this one ahead of the Fed and what that may happen. Dollar China as well. Keeping a close eye, not doing much. Where's it gone? There we go. More sideways action, but we're not seeing officials stepping in as hot for this one at the moment. There's been a lot of on the ground stuff going on. Kay put a story in the newsroom that they're merging a ton of like rural banks and things. A lot of large debts going on amongst some of those regional banks, rural banks. So why not have 50 banks when you can have one and merge them all together and keep everything contained? So they're still doing moves there. They're also opening up the property market, ending restrictions for home ownership and property ownership. So they're trying to stimulate things, but it's not really having an effect on the currency. And as we've seen from the data, nothing is picking up significantly over there. So still a bit of sideways action. I will be watching if we get above these 720s again and start to hold and move up. I have to rethink my shorts. But otherwise, just sitting on my hands for this one, waiting for it to crack on, as we say. Kay, you got any bits and bobs for us?
Well, I just wanted to show some of those yen pairs. Thing is on your euro dollar, it's in the range. Oh, just one thing about the Chinese yuan. Seems that they've sent out the submarines again, selling a few dollars against China, but then it's not really moving a lot. So the market's still not buying the Chinese revival. Let's put it that way.
Yeah,
still not there, you know.
Let me hand it over to you.
Right. Okay. Where are we? Here. Yeah, so that's what I was showing in the room, and so yesterday I was and the day before I was saying like, oh, this now really looks like an area that's really starting to fail, right, in the euro, and it's one that I'm really keeping an eye on. Perhaps, as I said, somewhere Q2 or so, this could really start to roll over. But also, if we get back into this zone and retest, it may attract my attention a bit more. But then in the meantime, you have to call a cat, and this could still be what the people call a bullish flag, right? and we have been forming many of them on the way up. And so that I'm always trying to look for stuff that could counter my opinion as well. And if it's not fundamentally, could be just pictures, you know. And this is worrying me a little bit because it comes down. But I know we are below prior highs, but we are getting back up to them. So if we get up above this, let's call it 160.35, 40 or so, we could actually see a bit of an extension higher. Now, this being said, what we see this morning is pretty much an overlay of what we saw yesterday morning, and that is European cross buying. We entered at relatively low levels yesterday, and we gradually, until around 1 p.m. London time, saw those bids creeping in. And this morning, no different. Euro a bit weakish to enter the day, with Euro sterling coming back down as well, with Euro Aussie being quite a bit lower, and then Euro Canada trying to retest those lows as well. And what happens over the course of the morning, we are edging back up. I think that's still end of month. So to make any decisions on pairs, I'd say wait for those 1 p.m. London fixings to be over, and then see how the market will react to them. Don't forget, we are not the main players, the retail market. What we think or what we hope is not what the bigger money is doing, right? So we are going to have to be a follower of fashion if you want to trade crosses, that is, okay? Because trading the dollar ahead of the FOMC is a bit of a bet to have, but I'd say that if we see that euro and euro dollar as well, I think printed its highs anywhere between midday and 1 p.m. London time yesterday. You see the dollar creep up again. Don't be really surprised, because it's likely still month-end flows, all right? And we could have more actually into 4 p.m. London time. We see the same thing happening on all those yen crosses. Look, the Aussie yen even broke, okay, yesterday. And what happens today? It's back in there. And this is where I want to just get the people being just a tad careful on what's happening here. We could argue as well. Kiwi yen came down. It's much more violent, this one. But just to show you that every time we are putting in moves lower, it probably drags in people through those levels, and then what happens? We are gradually moving back up. And Ryan already showed the dollar yen. Sterling yen is pretty much the same as the euro yen. Unsurprisingly, euro sterling is not moving that much. But again, here we could just be forming a bullish flag again. Okay, so I'd say still be careful. We are going to need to really break levels here. I was highlighting this 186.5 on the sterling yen. Yesterday we pretty much tagged it, and what's happening? We are going back up. So this, just to highlight the danger of people, because I know a lot of people want to buy yen because of the change in the Bank of Japan upcoming, because of the change in all the rest, the major central banks coming up as well. But I'd say be careful. Timing is going to be of utmost importance. And again, in the meantime, it's very hard to stay long yen for longer, because you're still paying away carry. But for the day, I would say just look at what happens on euro yen, because it could be again the euro being bought up for month-end purposes. Okay, just showing, because everybody is asking about this all the time. This low 86 on the dollar Swiss is really starting to be a very, very strong level, and this is one that I'm going to pay close attention to going into the FOMC. I think what we're seeing now again is a bit of euro Swiss buying. It gives the impression that we are breaking out of a triangle here, but I wouldn't decide upon anything before the FOMC, before the 4 p.m. London fix as well, because yesterday we saw a bit of a similar move where we yesterday here we went up, and then all of a sudden in the afternoon it came back down again. Okay, and I think this is relatively close to the fixing here that we printed a low. Same could happen again today. So this one I'd rather put it back when the 4 p.m. fixings will be over, or even after the FOMC, to see where we are. A bit similar, we always come back into the middle of that zone. Okay, but 86 figure 5, and then here this 86 85 30 30 75, or call it 85 and a half, 85 3/4. That's going to be a big zone for tonight. Top side, if we start to break back above 86.80 for starters, 80.85, then we are going to have a look back, I reckon, at what's happening in the in that zone where we were the prior top. You see, it's gonna be relatively close, around 87 and a quarter, 87.30. That is going to be the first really good zone of resistance again in dollar Swiss. If it breaks 88, 10.20. Okay, I've spoken enough about that range. BOE, we will talk about it tomorrow, Ali. But in the meantime, if you look at the cable, we are still trading ranges, right? We are trading ranges. Look at the cable in the look at this. Like it's looking like the patient has a bit of a heart problem, but it is really up and down, up and down, up and down. And we are really trading around the 127 right now. Tonight I'd be starting to get worried about the cable if we break under 126.40 perhaps, and of course we are still looking at 125.90 figure here, 95 figure. That's going to be 95.10. That's going to be your big support zone going into the FOMC and tomorrow's Bank of England. If our assumptions for a softish meeting today are right, I'd say that this should still be alive tomorrow, right? Unless Powell goes like, oh, forget what I said in December. I was only joking, and I think we are never going to cut rates. But that's something that is out of the question, I think, for today. Top side, if they would get dovish, we've seen those bit of rejections every time we get up to 127.20. That's your first area then to the top side, and then same thing. Can we break fresh levels to the top side? They will have to be very dovish on the FOMC to break those levels ahead of the Bank of England. So my base case is range, could revisit the edges of the ranges, but I doubt we break before tomorrow, Bank of England. And that's it for me, Ryan. Back over to you.
Thank you very much, mate. I'm going to grab it back just quickly. Just want to, if I can find it, hang on one second. Just something I showed in our chat room earlier, just looking at Euro Sterling. So we got this move still down here, still undecided what we're doing here. We had the rally yesterday back up through the levels. Just want to point out this pattern. When you're looking for signs of a bottom, you want two things. One, that it stopped going down, and two, that it's finding support at old levels. Sometimes you get patterns like this where it finds a level and just holds it. That's a bit more indecisive because it still make or break whether you go down or up. But the fact that it's not going down is a start. The same thing is here, but we made this low against a fairly decent level, broke the low, bounced from the low, came back, and now we're holding the prior low before this one. So that's a bit of price action I look for when trying to decide if we're going to get a bottom. Context is needed. We've got the BOE tomorrow, so that's going to have an effect if we're trading here around these levels. You know, these levels may not count, but just for where we finish the BOE and where we finish the week is going to be important for this one. If it's still above this area, particularly above 85, even on a test, then perhaps we're going to have a more solid bottom coming in. If we're below this area, below 85 after the BOE and ending the week, then that's a different picture altogether. But just on the short term, just gives you bottom pickers a bit of an idea of how to watch the price action that shows sign of making a bottom. Doesn't mean we are bottoming, but we've got more significant evidence than we've had all through this period here, where the price has stopped going down. That's always the first thing you want to do when trying to pick bottoms, make sure it's stopped going down. So that's my thoughts on Euro Sterling. Yeah, for the Fed, be safe. Okay, that's the biggest advice I can give you. We know from recent events data that markets can move, but they don't want to go anywhere new. If you're trading cable, park your bus if you want, 126, 128, let everyone else play with it in the middle. Don't read a headline and think this is going to move it 200, 300 pips and we're off to the races, unless it's obviously a game-changing headline. If you're in the flow, if you're in the ForexAnalytix chat room, obviously we'll be monitoring everything going on and commentating on that live. So you'll get our immediate thoughts on every headline, comment, Powell utterance. You'll know what it means for markets and whether it's anything we need to focus on. Until then, enjoy the rest of your day. Take it easy. Don't get caught in any trades that are just going to go sideways while we wait for the Fed. Trade safe. No horror stories, please, tomorrow. I want to hear you all making lots of money. And we shall have a discussion about what went on. Okay, thank you very much, as always, for your stuff, and we will see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.